Hello, everyone, and welcome to the new episode of Senzal Insights. Today, I have my special guest for the third time, David Orr. Welcome, David.
Well, thanks for having me.
There's a reason why I'm having him for the third time because, in my opinion, he's probably once in a generation hedge fund manager of his generation. He's probably the best in the world, or in 1% of 1%. And that's not just me talking, it's basically you outperformed the Buffett partnership in its early years, which is a remarkable achievement. Can you
Yep.
tell us something about that?
Yeah, well, I want to say up front too, that included a few years there of a personal account track record. So, that you could say that you shouldn't include that or not. But if you do, yeah, I just did performed way better than he did. I don't really know what to make of it because, the first few years I thought, oh, must be getting really lucky. And then the next few years it keeps happening. I think, okay. But I still think it like a little bit, maybe, maybe it'll slow down. But then now after like this year is going really well. So, it's kind of like, damn, this is kind of surprising to the upside. So,
And even this year, that it's positive, it's a good year for most of investors. You are like doing few times over S&P, and you maybe even approach a triple digit returns gross this year, which is crazy considering that you are not running a small hedge fund like you did like 3 or 4 years ago. Now you passed the 200 million threshold, which is, in a sense, it's still a small hedge fund, but you could be half a billion in 2 or 3 years. So it's completely different game. And the two podcasts ago, we even spoke about that you said it's a different game when you manage 20 million, and now that you are managing 10 times more. What changed?
yeah, well, part of the hack that I'm using is we have these other portfolio managers. So that's actually slowing down the scale impact, which I think is helping the edge a lot. But yeah, just even at this, my participation today is about 100 million. And yeah, so today just getting in and out of things takes a lot longer. Now, a lot of times I'm like wanting to bet bigger on things, but I just can't. Oh, I can only bet, 30 basis points on this micro cap. And in the past, that would have given the asymmetry on this specific one or whatever. I'd have liked to do more like zero point 0.5 or zero point 0.6. So I'm running into that kind of thing now with a decent amount of the portfolio. And there's definitely just a cost to that. That's especially true for the catalyst ones where, something horrible is about to happen in a micro cap and you just can't get yourself stuck there, especially in a micro cap short where if you're wrong about the catalyst or some unexpected great news happens, you really don't want to be stuck. So, yeah, I just have to bet smaller on everything like that.
And what in your universe is a small bet, and what is a large bet from percentage point?
It depends on like the company because for example, I'm short some consumer staple large cap stocks and in that case 2% is not big, right? That's just who cares if the consumer staple somehow runs 20% even, it's not a big deal. Um, so it's really hard to say what is a big and small bet. It's
Yeah,
just
it basically comes down to volatility, right?
yeah, and like the real risk of it, yeah.
And you spoke a lot about the last quarter. Last quarter is specific in a sense that it was really bad for short sellers.
Yeah, it was really
it was
tough.
horrible. It was like the like on the level of 2021 when it comes to in some sense it was even crazier because the basically the leading factor that outperformed was unprofitable highly shorted companies.
Yeah, as far as I know, it was the second worst period in the last at least 25 years, probably longer. Um, January 2021 was worse. That was maybe 30% worse or something if you had to quantify it, but that's getting pretty close to that level of tough market for short sellers.
How did you deal with it? I mean,
Yeah, we
you
made money.
definitely felt some pain.
Yeah, I just avoided all the right factors early this year. So I even warned um, the other portfolio managers. I even warned other short sellers who didn't listen. I said, look, these like fake electricity type companies, any company related to power generation, any of these kind of like science project, vague, just nonsense, like the super micro nuclear reactor kind of thing. It's all most likely nonsense, but if you're short this stuff and there's going to be an electricity bottleneck for artificial general intelligence, it doesn't even matter if you think it's true or not. It's just that's the narrative, and that's just the wrong one to be short. And that was probably the most brutal factor last quarter. So just avoiding all of that helped a lot. Um,
You
and then
completely
I
avoided it.
completely, and then like the ARC like stocks, my beta to ARC this year was like minus zero point 0.2 or minus 0.25 at the fund level, and I think a bit lower at my own partition. But that wasn't too bad because if you look at the individual stocks that I was short, they weren't like the really nasty ones individually within ARC. So that's why this year has been going so well. I just avoided I thought they were kind of obvious, to be honest. This electricity one was super obvious. Like, just don't be short that stuff.
Yeah, and especially the ones with with potential of short squeeze, basically, because everything was just, I mean, outperformance was crazy. And as you said, probably second largest or largest in this century alone. And when I know, we actually, in a way, predicted it in I don't know if it was the last or the first podcast we spoke about quality factor, and you told us that it's overcrowded, and now we have the largest underperformance of quality factor since in this century in
Yep.
last 26 or 27 years.
Yeah, I'm kind of regretting I didn't short much or more of it. It's just a hard factor to be short, I think,
Yeah.
but it would have been the good one. Yeah, but it's always hard to say when that would sort of collapse like it did. And even though it dropped a lot, it wasn't like, that good of a short. I mean, alpha wise it was, but so that's just a tricky thing to actually short, which I guess is what makes it such an appealing long too. But that's why the valuations got so absurd. Um, and
Yeah.
I know so many quality guys, they just don't want to sell, and it's such a big mistake. It's like, man, you gotta look at the valuation, especially if they're ones that aren't even growing or
Yeah.
not growing much.
And we even have a Terry Smith of Fansmith. He's basically underperforming now for 5 years, and
Yep.
his outperformance basically came from betting on that single factor.
Yeah, he was just a factor bet. I mean, there's a lot of these single trick pony kind of investors who get sort of famous and raise big AUM or um and I've been really critical of many of different ones on Twitter, and definitely he's just as much of an ideologue, I'd say, as Kathy Wood was, or as the value investors from 2000 were. It's all the same idea.
So I mean, it's basically marketing. I mean, you even spoke about that investing is a lot about marketing, not a lot about true edge and true performance. I mean, there's a guys. I mean, they are still managing billions or tens of billions, some of them. And Ray Dalio, I mean, I have a really negative view on him, and I
Yeah.
mean, but he is like Bridgewater is managing more than 100 billion. So
Yeah, he's a genius marketer.
yeah, genius marketer. So, but you also spoke about active versus passive and how in funds need to evolve to be truly attractive again, because active investing is mainly closet indexing or marketing. There's a rare percentage of fund managers like you that actually deliver alpha. And how do you uh, dissect, let's say, those funds? How do you know if someone is like has the potential or is worthy of investing with?
Yeah, you can just look at someone's track record and you need to not just look at the raw percent. You need to figure out like what their real benchmark is, for example. Um, so and that's important because let's say you had like a long only oil guy, for example, and then but obviously that's been a really tough um industry to be investing in after 2010 when fracking sort of switched things up and really changed things a lot. And in that case, if their benchmark is truly long oil stocks, and they performed really well versus that benchmark, then that actually means a lot. But a lot of guys are saying, well, my benchmark is like a really junky one. It's like, say, the Russell 2000 or something. And it's like, that shouldn't be anyone's benchmark. That's just
Yeah,
a joke of an index.
yeah,
I think that's true. It's like low key also true for like the global ETFs because people don't actually look through like what, say, the large cap European ETF owns. It's just a bunch of these really expensive, just stagnant companies, a ton of them. And it's like, okay, your benchmark is again just full of junk. It's not like Russell 2000 bad, but it's pretty damn bad. And that's not even a reasonable benchmark to look at either. So, you're looking at this, like I'm saying, two ways. One, if they do have like an honest benchmark, how are they performing versus that? And two, don't get tricked by this sort of fake kind of BS benchmark. And then yeah, if you can figure out like what factor they're actually betting on. So ARK is the sort of speculative technology companies. Guy like Michael Burry is just the hardcore value factor, and so on. And then you can actually test what their alpha is versus the real benchmark. And if they just consistently put up alpha, it doesn't have to be every quarter for sure, but if you even look over a few quarters versus their specific benchmark, um, they really shouldn't be having too much negative alpha there almost ever over that time frame. There's this really good book by I think Joe Petta something, I forgot his exact name. Really good book he wrote where he brought up the point of dispersion within the factor. So there are some years that are just conducive uh, environments for generating a lot of alpha in certain factors because like the range of outcomes for the stocks is really wide, right? But if you have a really narrow range of outcomes, you have sometimes have years like this for some factors, and there's really nothing you can do. It doesn't matter what stock you pick over that few quarters. It's just going to move with the index pretty much no matter what in a year like that. So I think being aware of that is good. Um, but I've also noticed like the single factor or single industry type of investor, they basically never seem to have an edge. At least I don't know of any. It might look like it for a few years, but then they really drop the ball. So I think it's better to typically look for guys who can at least play a few different factors at the same time. And then with that, let's say that now you can see, oh, he's generating alpha to like five different factors all at the same time, and you've
that's crazy.
isolated, then that's really gets interesting really fast. You don't need like super long sample size or anything.
Yeah.
If you see that in 2 years, it's like, oh, okay, his daily Sharp is like 1.6 and he's not really riding any factor. That's really good.
Yeah. And do you write any factor? I mean, I know that you have a lot of financials, if I'm correct, in your portfolio.
Yeah, we have some beta to some factors. So I think the financials is like maybe positive zero point 0.2 or 3. The energy, because we have the pipelines, that's
Yeah,
also
yeah.
positive versus like my beta to the S&P 500 this year is like, I think it's minus zero point 0.4 or something. So there's a bit of a factor mismatch there. but it's not like a totally extreme thing. It's not like my beta to oil stocks is like 1.5. It never was like that. In 2022, it was like, I think it was maybe zero point 0.4, zero point 0.5 positive, which was a really nice tailwind because energy stocks were so strong that year. But I wasn't betting the farm on it. So, um, yeah, I just try to bet on every factor. And I'm not really trying to intentionally make a factor bet even. It's just more like I've noticed financial stocks seem unloved and cheap.
Yeah.
So I'm long more of them. The pipelines, for some reason, they're cheap. So I'm just long more of them for only that reason. But as soon as they stopped being cheaper than the market relatively, I would just dump it. And, someday that could be who knows what. It could be these speculative technology stocks, even. Who knows? I don't really care. I'm not going to be an ideologue about it. Someday it will totally change.
Yeah, and you also we also spoke about being ideological about investing and how it's important to, let's say, be flexible. So as you said, I mean, from technology companies and let's say those with AI exposure, I know of that you only long the Taiwan Semiconductor and Google, if I'm correct, and Amazon, of course, as a let's say third wheel. But you passed on. Did you pass on NVDA on companies like that when they were like much lower?
Well, I played the NVIDIA bet because I made that post in 23. I said NVIDIA would become the most valuable company in the world, which at the time was a pretty bold call.
We did
But
the
then,
same. It
yeah,
was 2023 as well. Yeah.
but I just played that by shorting the inverse, like semiconductor three times ETF. That was a pretty good bet that way.
I remember.
Uh,
Yeah.
and then I also did some other weird things. I was like, I thought IBM could become hyped up. So actually, I bought IBM deep out of the money call options going out a couple of years.
Really.
And because the implied volatility on that was like 11%. So that was like a 50 bagger or something. But I
Yeah.
didn't stick around the whole time. I sort of waited for the asymmetry to go away there and then I quit early. But
Would you say that at the same time on the long side and on the short side, you bet on a lot of different factors?
yep, I do it on purpose. I don't want to have too much correlation to any one thing. And I'm trying to juggle. I skip at some sectors almost entirely. So biotech or
Yeah.
like junior mining companies or bunch of type of commodity companies. Not all, I'm in a couple commodity-ish companies, but that's not like a pure just like iron mining company or something. I don't, who really knows. But besides that, I try to play nearly every factor. I'm not in software either. That one's too studied. So people have really, really studied software stocks a lot. And I'm just like not going to compete with that. Too many eyes were on it.
Yeah. I mean, I mean, I completely get your point. But what to come back quickly to a quality factor? I mean, he's underperforming heavily right now. Is it? How far are we from actually being attractive again? I mean,
I don't
26,
know,
27
st
years of largest
stock
under.
like Nike or something, maybe it's getting kind of beaten down here, but also, the earnings have been pretty weak. So is that going to reverse? I don't really know. Something like Coca-Cola, I don't think he's long that one, but um, something like that is very stagnant. They keep having to do these acquisitions simply not to lose earnings even. So that doesn't even seem that great. Pepsi's the same idea. Maybe Pepsi's a little bit better now. I don't know. Some of the consumer staples we'd call it a quality stock, like Diageo, the company that owns
Yeah.
Guinness and some other. I like that. I'm long that. I have the Kiko Man. I'd call both of those pretty high quality companies, even though the return on capital today isn't super high. But so I don't even know if they're technically in the quality factor. Yeah, I mean, Microsoft was in the quality factor. I guess that sort of has been working. But is that Does it seem cheap? No. Uh, I don't. So when I look through a lot of the quality stocks, I just don't get it. Even today, the earnings multiple seems pretty high for often the earnings aren't even going up. That's what really blows my mind about it all. It'd be one thing if these things were just year after year earnings are going up 5% a year. That's, you could say, well, you could pay a pretty high multiple there. If you get that plus few percent dividend and you have this in theory pretty safe 8% yield, even at say 30 times earnings or whatever. It's a little aggressive, but you could sort of get it. But these stocks aren't even doing that a lot of the time. Yeah, often they're like I'm short Starbucks. I think that's probably considered a quality stock, and it's beaten down a lot. But when I sort of see what's going on in the real world, it's like there's already like four Starbucks within a 3-minute walk from me, and then they're already really, reasonably crowded. But then when I like look in between each one, there's like these up and coming, really better, just they're better coffee places. So if Starbucks is one already everywhere, and two, the competition just seems better, that's a pretty dangerous mix. I think McDonald's is the same idea. McDonald's has to be considered a quality stock, right? Or um, so that one again, um, Shake Shack just makes a better product, right? I guess they're a bit different price points. Maybe McDonald's for the price points, like pretty good, I guess. Maybe that one's a more iffy example. And they do have some room to expand internationally still. Maybe not as much in a country like Japan, but in poorer countries, definitely. Um, let's think. Trying to think of more examples. Yeah, I mean, like Costco is just a bubble, isn't it? I mean, it's just kind
Yeah,
of
that
ridiculous.
that just popped in my mind. It's
So, well, I
crazy.
mean, so when I look at that, but that's the thing. When I looked at Terry Smith's holdings, I swear that's like a lot of his holdings are they just look like Costco to me. I guess at least Costco does grow, and you can sort of it's like actually a pretty good company.
Yeah, but they're really expensive for its growth.
Yeah, that one I actually believe in more than a lot of Fundsmith's holdings. Fundsmith's holdings are just these companies that really have sucked for a long time. And sure, the return on capital number is attractive, but what the hell does that actually mean? I don't think it means much.
Yeah, especially because mostly it's backward looking. If we look at
Yep.
return on invested capital, I mean, it's history. It doesn't mean that it's going to be high as it used to be, especially if they are operating in highly competitive markets like Starbucks. We now have Dutch Bros, if I'm not mistaken, in US. In China, we have a Luckin Coffee. I mean, they are getting competition from all over the world basically, and there's a trend in like smaller coffee shops that, as you said, they're basically serving better coffee. And but what's also interesting when it comes to Starbucks is that a lot of Starbucks customers are like, it's Starbucks. So I think that basically the valuation and any premium that comes with it is tied to that intangibles part. And if
Hmm.
it's shaken in a way, everyone knows that that coffee is really expensive. But if it's shaken, I mean, the brand needs to suffer in a way for it to truly, I mean, go lower. And probably now, I don't know if you agree. I think now the main problem is probably the unions. Uh, when it comes to Starbucks, they get. I mean, people expect of Starbucks to be like. I mean, it's like McDonald's. It's mainly for students to work there when they are studying for college, and it's not something where you work if you want to raise debt to buy apartment or something like that. So I think they are getting pressure from that side as well. That might be interesting. I don't know if you're
Hmm.
following that situation right now, especially in New York.
Yeah, I think that's true. Another headwind for Starbucks is the GLP-1s because they
Yeah,
sort of people think Starbucks and they think, oh, it's like a coffee company, but when you actually break down what products they're selling,
Yeah.
I think it was like 80%. It's some really high percent is not just coffee or not just, the low calorie option. It's just these sort of super sugary, syrupy, or like it's like a donut, but it's not, donut has sort of a negative connotation to some groups of people, but it's basically just a donut shop at this point. It's like, okay, you go and you get your sugary drink and your scone, and a scone is just a donut, right? So, or like a cookie. Um, so yeah, I think that's another pretty nasty headwind. That's part of why I'm short anyway. I think that company's in a lot of trouble.
Yeah, from multiple angles, basically. And as you
Yeah,
said,
what,
I mean, it's low barriers to entry, basically. Anyone can open a coffee shop in your neighborhood, and they did a
yeah,
good job so far, but are they going to continue to execute? I mean, I agree with you. And
yeah. I mean, I just thought of another quality company like Marriott. I think maybe that's good. Maybe that's a fine long. I'm trying to think of other quality companies. Because I've been long Marriott in the past, and that's just like a, franchise business, so it's just pure profit. Um, they own a lot of really, really good brands. They have a lot of really unique locations that are pretty much never going to get replaced, at least at the high end. Maybe at the medium end, it's more commodity-like. It's not as good, but the loyalty program seems pretty sticky. I know a few different people who love their Marriott points. Even it's not rational. It's just like they're gonna stay at the hotel they don't even want to stay in to get the points. That's got pretty good value, right?
yeah, did not know that, to be honest. And when it comes to you're currently living in Japan, it's been like more than a year, 2 years now,
It's been 1 year here.
1 year there. How do you like it there?
I love it here. It's great. I mean, the thing is I'm working like all the time, but yeah, whenever I go out, there's never a problem. The food is delicious and healthy. It's not just the Japanese food that's good, that you can get like any cuisine. It's easy to go on a trip with my wife, go on vacation for a day or whatever. I really like the onsens. Um,
And
yeah,
sorry, man. And how do you like Sanae Takaichi, new Japanese prime minister? The stock market
yeah.
popped up when she won.
Basically, she's going to do a lot of stimulus, and it also seems like she's fine with letting the, monetary policy be loose. So she's just basically saying we're going to devalue the yen even more. She seems completely fine with this. Um, and I think it's all good for stocks, especially, these like any kind of like levered real estate play, any kind of company that's going to export their product. Um, it's good for tourism. I can see why she's doing it. It's probably annoying for the Japanese people. I feel
Yeah.
kind of bad for them, but overall, maybe it's a good strategy for their economy. I don't really know. Um, and then, she's kind of tough on immigration laws, which I actually sort of like it, even though I'm here. I sort of want them to stay really picky about who they get to live here. Even if, like, now, just today, they're coming out with the news that they're going to change the naturalization. So if you wanted to become a Japanese citizen, that's going to change from 5 to 10 years, apparently. And that's on my radar as being a possibility in the future. I'm not, you know, not confident I would do it, but so maybe you could say that's kind of annoying that way, but overall, I actually like the plan of making it more difficult to stay here. Um, and then I love her hardline stance on China. I love that she parked those missiles just east of Taiwan, just sort of uh, doing the face saving thing. No, no, that's our territory. It's just for our own defenses or whatever. And it's just this got to be super aggravating to Xi. So I love that.
And how do you see that situation with Taiwan? And I mean, I've seen the recent Trump post. He basically didn't touch that part at all. But I read some analysis, really interesting ones, that this is for in a long time that Chinese actually were the ones to call first because Xi Jinping requested to have a call with Trump, and it was basically about Sanae and her stance on Taiwan.
Hmm.
How do you see
I
that
don't.
unfolding?
My theory is just that posted about it. I think that she really wants to take over Taiwan, of course, but the and the fact that yeah, he's taking it so seriously, this Japan thing. I mean, they're flooding China with the propaganda too. And the fact that yeah, that's like a strong tell because I think that the they like in the last 25 years, China's only ever called America twice first or something, and this is
Yeah,
now
yeah.
number three. So yeah, it's yeah, maybe it's bigger news than I realized, but after studying the technology of the submarines more, there's so much uncertainty there. I don't really see how the Chinese could feel comfortable invading Taiwan unless the president said, like privately and explicitly in a phone call, we will not intervene. Right? Because if there's just that uncertainty there, if you just refuse to answer one way or another, that's how you lose power. That's how the Chinese Communist Party could actually lose power. Because I think the kill to death ratio, from what I'm studying, it would take a crazy amount of lives just to sink like 5 to 10 American submarines. And I think in the meantime, America would sink like half of China's entire fleet or something absurd. Because basically, the thing to realize is that China's good at like mass manufacturing things, so they have a big volume advantage, but they don't have the technology advantage, especially for this kind of super important top secret technology where nobody actually knows the exact capabilities of these submarines. That's like very, very confidential information. But we know that the Chinese technology is way, way behind. We know that really confidently. Um, it's at least 20 years behind or something. And so, if you're just thinking this through and you say, okay, is China really going to risk basically losing this war in the matter of weeks with extremely one-sided losses? And they'd be like the moral asshole too while it happened, right? Then the whole world would be angry at China for even trying to do this to Taiwan at the same time. It would just be a complete disaster. Um, so when I look at it that way, the invasion seems insanely unlikely. But it's also weird that China took it so seriously that Japan just parked some missiles, east of Taiwan too. So it's like two conflicting signals here.
Yeah, and I think that China is slowly catching up with the US. I think the main problem is, of course, the semiconductors. That technology is still far behind, especially when it comes, I mean, to nanometers of the chips. And but yeah, it's China has a long-term goal of have that one China policy that Taiwan is a part of China. And I mean, if you look at the history, those are technically the Chinese people. They are living in Taiwan. They are basically Democrats that were anti-communists, and
Yep.
that's how they basically escaped to Taiwan. And it's interesting that Xi Jinping is like, let's honor the sacrifices and deals after the Second World War, because China was on the right side of the world, and on the other side, Japan was on the side of the Axis powers, which is really interesting. So they are trying like to switch that narrative in a way that Japan was evil at 8 years ago, but we were good guys. So
Hmm.
you should be on our side, not Japan's side. But there's a really large American influence in Japan, and I see Japan as let's say a proxy, someone that's going to provocate China on the U.S. behalf. And but on the other hand, I don't see the probability of going to war when it comes to Japan and when it comes to China and the US, I think it's really low because I don't think it would be like it could escalate. I mean, two nuclear powers basically. So it's a completely different world we currently live in, and but also as we can see now in Europe, European Union and US are basically waging a war against Russia through Ukraine. And I think it's possible to have some kind of scenario like that. And I even read some analysis that claim that China gave up on aggressive approach towards Taiwan and they focused more on soft power and influencing Taiwanese in that way and giving them good deals, showering them with money and stuff like that. I don't know how if that's true, but it's definitely something to at least do a research on. I don't follow that part of the geopolitics. And how do you see the current Trump term so far?
I like what Trump's doing. I'm a fan. Like one of my worries was that he would actually, I know he made a campaign promise, so his base is kind of pissed off that he didn't live up to it and just like leave Ukraine to fail, essentially. So I didn't want that to happen. So I'm pleased that that would have been like the worst part about Trump to me. And instead, it was what I was saying in I think our first call, where I said I don't think Trump's this kind of crazy person who doesn't care at all. I think he was just trying to play a political stance, a way to end the war politically. It didn't work. I thought it was worth trying. Nothing was really lost for having tried. It might have worked. It's easy to say now, oh, well, that was a stupid story arc where he was kind of, at the time, he's like being straight up friendly with Russia.
Yeah.
Um, but it didn't work and whatever. I think it was totally worth trying that. And now it sounds like he might actually negotiate a peace deal. And that's what I was telling my friend was like, well, if you sort of looked at what Trump ran on, the idea that Ukraine would even be Ukraine at all still is just nonsense. Like that there's no way that they would continue fighting back the Russians without the American help. Um, and then instead, what with Russia got the huge sanctions, which was like a huge blow. Um, and so so basically I see it like if Trump can pull off a peace deal where, yeah, sure, they'll have to give up some territory. I don't even care at all about that. This whole argument that that's terrible and wrong. It's like actually the eastern half of Ukraine was already pretty pro-Russia anyway. If you like looked at the polls before the conflict, it's like, okay, well, if they wanted to be part of Russia, maybe this is just sort of the natural way things should go, is like they should actually be. Of course, it's far from perfect and everything, but I think if you say, okay, we're going to give up the borders and then you give time for people to leave, right? Sure, they'd lose their house and things, and that sucks, but it's not that bad. And then they could decide presumably which place to live. And yeah, I think if the peace deal can happen that way, that's a good thing. People have to be realistic and say that the war is, Russia's slowly grinding away and getting territory. That's just been happening all year. Um, so yeah, I think just hopefully the war ends that way. Hopefully Trump's peace deal works.
Sorry, man. I need to answer my call. It's my CEO calling. It's probably something really important.
Yeah, no worries. We can just restart it one second.
I'm back. Sorry, man. My CEO sends his regards,
Oh, cool.
and it was not something really important. But I know where you finished. So I mean I have the follow-up question.
Okay, I'm ready.
S- So, from the point of uh, ending the war in Ukraine, I mean, do you look at the possible investments over there? For example, I was recently looking at some Polish companies, even Austrian or even Romanian, but I think that Romania is too small for you when it comes to volume, because there are going to be some of them that are going to reap the huge benefits of rebuilding of Ukraine.
Yeah, I just don't look at Eastern Europe because, like you're saying, it's so illiquid. Um, I wish I could. Otherwise, I would be. It's just one of these things where it has to be about size and how that gets you. So this is just another way. If I had $30
Even
million account today, I would do it.
even Poland is too small for you right now. Yeah, that's a shame.
Yeah. I
That's a
have
shame.
I have some of the Polish stock exchange, like a small bet on the hedge fund, but that one's not even that cheap or anything. So, I only have still for I think for tax reasons or whatever, it's not even that one's not even high conviction. But when I look at a couple times I'll get linked like a really, really interesting Polish stock. I'm like, damn. But then I'll go look at the daily volume. It's like this 40,000 bucks. This is
Oh my
can't
God.
do it.
That's nothing. That's crazy. And what's your stance on military companies on US and for example, we have Transdime that went down a lot from the high. They do have a really strong competitive advantage. They do have investor-oriented management. Let's put it that way. And I mean, on the other part of the ocean, we do have Europe, and some of the European companies are in correction right now, from mainly from expectations of war ending soon. But if we look at the bigger picture, they are still committed to raise the spending towards the 5% of the GDP, and they are going to build. I mean, Germany is rearming, Europe is rearming. Is this do you look at them at all? And if you do you look at this correction as a possible opportunity?
The thing about military is I feel like the Ukraine war showed us that um what's obsolete and a lot of the old large defense companies, a lot of their business I would just say is obsolete. Maybe the government does or doesn't actually order it anyway. Government can kind of be that way, at least sometimes. But say some of the times the government doesn't make the mistake. So you could say that they sort of actually have this headwind another way. So even though they've got the tailwind of European countries spending more, maybe a quarter of their business is totally obsolete. So that's like a pretty big problem. Um, And then another problem is I think I have very little faith in the European leadership. So I think if was a peace deal, I think those 5% targets, they just, once the virtue signal is done after people not thought about it for 6 months,
Exactly.
um, and then now now you have a huge problem. If you combine, now you have two headwinds. So maybe you could even say it's maybe a short, especially the European ones. Like I don't know, I didn't even look at it in a long time. Rheinmetall, things like that. I mean, that could be an interesting short here, but I haven't looked at it. Maybe it already dropped a lot. Is it RHM? Look real fast.
Yeah, it basically went down double digits, like 15-20% from the high in a
Oh, that's it.
relatively, yeah.
So yeah, maybe this could be a good short. Actually, I don't really see it as a long here. Um, yeah, and that's a short. I'm gonna short this. I'm for sure shorting this.
Uh,
Uh, yeah,
we
this is a no-brainer.
we found one.
Well, let me see. So basically earnings were bad for a long time. Not even that bad, right? I was long this before the war even broke out. and then I sold way too soon. But what now? The multiple is probably really high. Yeah, I'm just like this is 100 times earnings almost or something. Like, yeah, it's
Yeah,
like real
it's
too.
really
The
expensive.
short. This is the short. This isn't like a buy the dip.
Amazing. This is not financial advice, of course.
Yeah, no,
You
to
need,
be, my opinion might change tomorrow and everything. Who knows?
yeah, yeah. So you need to make your own decision, guys and girls. This is just like a live discussion, and I love it.
That's my research process sometimes. That's not an exaggeration.
And,
That's how
and,
I
and
do it.
and that's my point because when we spoke before, you were like, guys, you told me it doesn't not need to be complicated. You need to have like, if you can write it in like 5 sentences, that's it. It's
That's
need to
it.
be short and it's need to hit the point to hit what's the catalyst basically. And
That is such a beautiful chart too. When I look at the chart, I just like shorting charts like that. Uh, maybe this one could somehow go to like 2200 or something and you lose 50% on the short. That's not even that bad for a short, right? Like shorts lose 50% all the time and you don't even think about it too much. But man, if Europe pulls back on the defense spending because the war ends, this thing's going to drop 80% from here
easily,
easily.
easily. And if they are rearming, what are they rearming for? I mean, are they? I mean, they'll have to do something about that. I mean, they have fiscal deficits that are really hard.
Well, especially, did you see part of the Trump's deal apparently is that the Ukraine will be able to join the EU. If that part goes through, they won't rearm for sure, because then for sure, I don't think there's any threat that this would happen again, really, right? Maybe not any, but it becomes way, way less likely.
Yeah, and
And
Russian focus will switch to other nations like Moldova, where they are already present, and those, let's say, non-EU, and they are successfully pushing Russia out of the. What's actually interesting right now, and a lot of people don't know about it, but our largest oil company in Serbia, it is under sanctions from America right now because like 56% of it is Gazprom ownership. So I
hmm,
think that the part of the deal is, and Russia had a presence here for basically centuries. So I think that that part of the deal between Trump and Putin is that they want to, okay, they're probably going to go like, okay, here's those parts of Ukraine, but you are going out of Europe. Your influence is going to zero. So I think that they are going behind the doors. They are probably going to make a deal like that because this company is under sanctions, and it was actually a company that was operated well, which you wouldn't expect probably from Russians, but it was operated really well. And now they forced us basically to nationalize it or sell it to some Western partner or something like this, because it's basically the leverage for Russian politicians to influence politics here, and they do want to kick it out. I mean, Americans and Trump administration, and they are really hard on that. Not only in Serbia, of course, but in pretty much they are squeezing Russian influence out of the any country. They did successfully in Bulgaria a few years ago, and they are doing it pretty much anywhere. So I think that they are like basically kicking out Russia completely out
I
of
think
Europe.
that part I strongly agree with. I think this idea that basically Europe got put into a nasty recession because of their mistake relying on Russia. So I think that I would strongly believe that they're not going to do that again. So that's a smart call. So in this case with the Serbian oil company, um, yeah, it seems quite likely that Russia will be forced to divest. Maybe as part of the peace deal, they'll actually be given a fair price for their share. But I don't, maybe they'll even be allowed to continue owning like a minority stake. I could see that too, but But yeah, this idea that we're gonna like live with Russian ownership of energy assets in Europe, I don't see it.
Even though it makes no economic sense, because gas, it's, I mean, you have a southern pipeline that goes through Turkey. I mean, it's really important. There was a project for the northern pipeline that got blown up. I mean, and when it got blown up, I mean, it was basically for everyone to realize what's actually going on and what is going to happen, and that is that Russian energy Russia gets the influence through energy, and even though that energy is cheap, and that's the complicated position right now, because if you get the cheap energy, you get Russian influence. And if you want to not have Russian influence, then you need to pressure your citizens with higher costs of energy, which is like a really complicated situation for European politicians. And with them being this slow, and the which is the craziest thing in my opinion is that in this situation you are going towards net zero. I mean, it makes no sense. I mean, and Trump was spot on when he said to Keir Starmer that, I mean, you do have a lot of energy reserves. Go and drill, baby, drill, as he put it. I mean,
Yeah.
UK is in complicated situation. I mean, you have a way out. You have a way out, and if you look the carbon output, Europe is, I mean, not a large percentage of the total world, and
Hmm.
the developing nations are way higher. Sorry, we drifted from the we went into something completely different. What I wanted to ask you, you said that you went through every single one of Russell 2000 companies. And what did that teach you? Because I started studying for CFA, and I realized that there's a lot of things that I really don't care about and that are like not really useful. And I was like, okay, maybe I should just go through Nasdaq. I'm going through Nasdaq still because it's like 3.7K companies, which is, I mean, a lot. And how did that process look like for you? I mean, because 2000 companies is 2000 companies. And what did that teach you?
Yeah, so my process was it's as simple as you like there are a bunch of different websites. You can get a list of all of like the stocks in it, one of these broad indexes. I got it in a Google sheet, and then I would just copy like the ticker into something like a ticker or any of the company websites out there that will give you the about the company section and the financials section. And so, in my opinion, you're just sort of it's like learning a language almost, where it's just about a number of reps, a number of time spent. And so after you like read about enough different companies and the type of earnings characteristics of those companies, you learn like what quality management actually does to a company over the years, for example. And you learn what like bad management does to a company or mediocre management does to a company over the years. And I think to actually see it, yeah, you can like build some lame uh model, which is what the CFA sort of way of doing it is. Think about it in terms of modeling and everything. I think it's nonsense. Just go look at what happens in the real world. You don't need a model. So, so yeah, and you're just sort of going through and you say, okay, this is like a company that produces this kind of a steel component, right? And then you can go look at the financials. And then if you've like looked through a ton of other steel companies, you sort of know which years are weak and which ones are strong already. You don't even, after enough reps, you don't even spend time like figuring out why this is so lumpy. You just sort of know, oh, it's lumpy and they had a bad year there, but that there was no reason that it was actually bad. It's just a tough year for steel or whatever. And then yeah, and then over time you start understanding like what it means when a company is stagnant, their products are becoming more competitive, they're not innovative. How does that actually play out in a number of different industries? right? Because it's very different. You could say like a Coca-Cola type thing has been stagnant, but that's basically fine, right? But then a other company, if like they make pagers or whatever, or something that, is
Ah,
just not going to exist
Exxon.
anymore. Oh, which one?
Exxon.
Exxon,
Yeah.
the oil company.
No, no, no. I don't know how to pronounce it correctly. They are making Axon or I don't know how to pronounce it.
Uh, Xerox?
No, no, no. It's
Oh,
they are basically making Exxon Enterprise,
I don't know this one.
Axon, or let me, and you'll tell me how to pronounce it correctly. Uh, this one.
Oh, I don't know this company. I've seen it before. I just don't know what they do. Is it probably some kind of technology company?
I think they are making pagers too. That's why if I understood you correctly,
Two segments,
they are popular
software.
retail
Oh, I see.
company.
I skipped this one just because I saw that word software. So I don't, yeah. Cloud-based software solutions. Uh,
I mean, they do a lot of stuff for police, for example.
mhm. Yeah, but yeah, so if you have some product that's like stagnant, and you actually want to understand how this plays out, and if you get enough industries and different mixes of like, let's say you have a stagnant product, but it's like a great management team, and how does that play out? And then what if it's like a better kind of industry that doesn't matter as much if it's stagnant, but it's got like a bad management team? And I think over time, if you just look at enough companies, especially when you've like looked through, say, because you're going to repeat a lot of them, or you're going to start looking in other markets. Once you start getting into like the 10 to 20,000 company range, your brain is gonna like notice things. That's what I think. Or if you have a talent, you'll just start noticing things. And it's those things that you notice that you can't really mush into a formula because there's enough. Like if you let's say that, you have like an industry, you have a quality within the industry, you have a subjective view about what the management is, you have like another couple variables. This is so many different inputs that there's like a zillion, you can't like build a model for this thing, right? It's Yes, and you're just hoping to notice things over time. That's all it is to me, is your brain's going to notice these sort of unusual patterns or things that just pop out to you. That's the best. When something pops out to you and you can describe it in just a few minutes or a minute or two or whatever. And that's what I'm trying to do when I'm looking through stocks. Um, And I don't spend too much time on any one stock, It's more like, okay, I've read the description, I've looked at the financials, maybe I've like looked up the inside ownership or read something about management in some cases. Sometimes I don't even go that far, right? It's more like in a minute or two, I'm done. And then some companies I'm skipping entirely. I'll like pop it up like, oh, software company, skip that one. You pop it up and it's like a small bank. It's like, I don't care about this, skip that one. Um, and then yeah, and then I think once you start like getting those reps in, because when I was first starting, I would just do this. I'd wake up, I'd do it for 15 hours, I'd go to sleep, and the first thing I wanted to do when I woke up again was just do it again. And I did this for months, just nonstop. Uh, so that's where I feel like I really learned the most about investing. And nowadays, I don't think I'm really learning that much more when I do it. So there's not really a need to do it now. Things just sort of yeah, review not as many companies every day.
And how much did you pass? How much time did you spend per company?
Yeah, on average, it's like probably a minute or two, and then it's got a,
Really?
a right tail though, because a lot of them I'm done in less than a minute or 30 seconds. But then once in a while you're spending like a lot more. So maybe with that a lot more, it's more like a few minutes. I don't know exactly, but it's not a
And,
lot on average.
and what we say are the main green flags and what are the main red flags? When you are looking, let's say for a minute. So yeah, it's if it's biotech, if it's software, yeah, we exclude them completely. But what are the like quantitative things? I suppose high debt.
Well, I'm looking for both longs and shorts. So there's
Yeah.
not really a red flag. I'm more trying to like cut out things that,
Yeah.
you're like, okay, this thing is a medium quality business. It's kind of stagnant-ish. Management has no skin in the game. It's trading for like 12 times earnings. Is that really that interesting of a long or a short? Because it's not really shrinking. It's just sort of nothing's happening. If return on capital is really low, I think it could be a pretty good short. Um, but otherwise, that's not interesting at all on the long side to me. Or even if it's 8 times earning, it's not interesting as a long to me. It's just junk. But it's not good enough to short either. Weird things happen. These things can squeeze. I already have enough sort of factor exposure to that kind of thing anyway. I don't need the better, you know, better middle portion of that kind of stuff. So I just try to skip that quickly. Um, but if I can find a company where revenue is kind of going up over time or revenue is kind of going down over time pretty steadily, and then I try to think about, well, why, right? And then multiple doesn't matter as much in those cases, right? I mean, it matters, of course, some, but if you can figure out, oh, this company's revenue is going up and it trades for like 14 times earnings, and they have a pretty nice payout and business quality seems pretty decent, you know, that then I try to figure out why. Can I understand this industry more on the long side? Longs are way harder because longs are harder because you have to like spend more time figuring them out. But they're easier because once you've figured out a long, you can like I've had some of my longs for 5 years now, and I don't have to replace them too often because if you get it right, they just sort of keep on winning.
For me, for example, it's the opposite. For me, because I was mainly the long only investor, and for me, it's I know I know why I have the company, so it's easy for me to have them. And on the other hand, when the short pops up like 10, 20% without a reason, I'm like paper hands. Let's use that word.
Mhm.
And it's complicated for me, even though nothing changed. I'm like, okay, maybe we are having I mean, look at the last few days, for example. Really bad rates, really a lot of real bad companies went up in the last few days, 10, 20%. I don't know if that's the case, but rates specifically, also a lot of consumer discretionary went up without a single reason. And for me, I find it challenging in a way. And how do you deal with that?
Well, in this case, it was just because the odds of the rate cut is changing so
Yeah,
fast, right? That's why we got the nice drop, and that's why we got the sharp rebound. Um, so yeah, obviously my short book went poorly the last few days too. But overall, I was, decently balanced. So I think I only maybe lost slightly through it, or maybe we're flat even. So I'm just trying to position it before you even go in. I think I've mentioned, so I think the best example for the rates specific is rate factor is just real estate. So I'm short a bunch of these crappy office buildings, and those went up like a lot.
yeah,
And right, but you can balance that with some more rate sensitive kind of shorts too, or sorry, longs. And you don't want to have too much exposure. Like I think crappy offices are just this wonderful short here, and yeah, I'd like to do even more, but I know that if in this kind of a move, you can get slaughtered if you have too much of it. So I just keep my gross exposure reasonable, and then I'm aware of like what other types of things I have that have the same kind of rates exposure, especially hard. That one's like hardcore rates exposure. Like if you're
yeah,
short real estate stuff, you're going to lose badly when this is happening. That's just a fact.
yeah,
So you just want to be aware of like what your sensitivity to the rates factor is. And I think I mentioned in a previous interview, you have these correlation buckets. And so I have offices in their own bucket, but I know like out of all my different buckets, which ones are actually going to be correlated to rates. So I'm like, this one, that one, and this one are probably pretty damn correlated to rates, right? And my total short exposure to these things is like 12% or whatever, right? And then, but I've got a fair bit of good longs to pair with it that'll protect me. And so overall, it's not, maybe you're going to lose some money during this period, but it's not that bad if you're balancing it right to begin with.
And how are you preparing? I mean, maybe we don't get the next cut in December, but I mean, it's certain that Trump is going to put someone he agrees with in the May as a new Fed chair. I mean, I think it's a high probability of probably being Christopher Waller or someone like that. And I mean, the reality is that probably rates are going down, and with rates going down in, let's say, next 2 to 3 years, how do you prepare for that scenario? Because in that scenario, a lot of that junk rates are probably going to go up 50, 100%.
Yeah, so to be clear, what's going to happen is when those expectations are changing rapidly, that's when the damage happens, right? So besides that, it almost has to happen, right? I mean, if you're saying, oh, well, rates are going to drop 1.5%, then real estate basically as a whole, it has to move
Yeah,
that way. But you're not shorting real estate as a whole. You're shorting like the insolvent, crappy office, right?
yeah,
So during that move, you're probably gonna like lose even more on average during that
yeah,
sharp move. But these moves don't happen that often. You sort of remember them because they're so painful and horrible when they do
yeah.
happen.
You're right.
You gotta block that crap out, man. It's just like, okay, I positioned myself to survive this. We lost 1% or 2% of NAV because of this. That sucks, but it's not the end of the world. And then it's really annoying when like 3 weeks later the thing happens again against you. Like, damn, we just lost another 2% this way. It's really lousy, right? Especially if it happens rarely. Three in a row, it's really, really crappy. Um, and that'd be a pretty extreme outlier. But then yeah, so if you're positioned to lose a couple percent each time, now you're down 6, 8% or whatever. It's not the end of the world, right? And then now you're pretty set up. Now, most likely it's not going to happen four in a row, right? And rates can only actually go to zero. And then after that, your insolvent, crappy office, it's going to trend to zero most likely. I mean, if you're right fundamentally, um, so that's, yeah, you position yourself to defend it. You don't change what you're doing just because the sort of unlucky thing happened. I don't think anyone can really predict which way rates are going to go from here.
Yeah,
Or if they can predict it, I don't know, think they can know how much it's priced in, because, even though it'll move some, it just, if it's really obvious to the market what you're saying, because people think about rates so damn much. Like that's all they do. They just sit there and try to guess what rates are going to be in a year. Um, so
yeah. It's pointless in a way to guess something. I mean, it's completely unpredictable. Only thing you can do is that you can, from time to time, bet on rates with futures and basically look for asymmetry somewhere. And
that's the
if it
only
goes
time
that
I
way,
bet
it
on
goes.
them.
What?
I only bet on them once because in 2020,
Yeah,
everyone was saying they can't go up. Well, like, they can't. What do you mean they can't?
yeah,
So I
yeah,
look at the odds. I'm like, oh, okay. Well, they're saying 200 to 1. Like, all right, let's go. I'll
yeah,
play
yeah,
that. But no one's saying anything like that today. If you look at the, I sort of have them on the screen. I look at them once a month briefly just to see what people are thinking. It's all like very competitive and people are actually looking at the variable a lot today. If someone has an edge today, it's not that big. It's not that 200 to 1 nonsense anymore.
yeah, yeah. And the also really interesting thing you said is that you could easily short. I think you said like 25% of the U.S. stock market. You said like that like a month ago, and it's really interesting. Especially, I recently looked into data. I don't remember who published it, but the point is that only like 3% of the companies were like 95, 97, something like that percentage of the total return above risk-free rate, which is, I mean, it's crazy. I mean, your goal is basically to avoid shorting those companies, and by excluding tech companies, I mean, it's a really low probability that you are going to stumble on any kind of those, and on the other hand, there's a fine probability that you are going to long. at least one of those companies. For example, like TSM or Google or
Yeah. Yeah, the trick is you don't want to get run over too bad. And everyone, they're always trying to short like this really because like if you like just forgetting about the whole thing I said about the rate sensitive shorts, which you're gonna get killed on. But if you're short like the worst 2, 3% of companies, all of that's going to be correlated too. And it's going to
yeah.
be correlated in a really, really bad way. So I've said in a previous conversation, I don't short any of that stuff. I really mean it. I would just try to avoid it, or at least wait for some blow off top kind of move and then short some. But to me, shorting it today seems like crazy. I wouldn't short that, and that screws you up. But if you can sort of cut out that worst 3, 5% of stocks, really even three, it's, if you can just avoid that, and they're really obvious, they totally suck. And sure, in 10 years, they'll probably all be down 99% and everything. And, it doesn't matter. Who cares about that? What matters is path dependency. And, again, I had to learn this lesson a million times. I still screw it up sometimes, but yeah, if you just avoid those, and yeah, if you can short the next 25% of stocks that all suck, and there's like 800 things you could short that will do this, they're going to sit there and grind alpha for you like double digits or something, and it's going to be amazing.
We also spoke about that you were considering longing some of the junk companies because yeah.
I couldn't bring myself to do it. I should have. I said I should get long arc in that conversation, I think,
Yeah.
and I didn't do it. I should have. It would have worked.
Do you still consider it? I mean, not. I mean, it does not need to be like junk, but let's say something like hyper growth companies, look like AppLovin, for example, or
Well,
stuff.
luckily, the other portfolio managers buy that kind of crap sometimes, so we get
Okay,
exposure that way now.
okay, that's
And
amazing. That's amazing. And how do you see the current situation with the? I mean, I have to ask you that it's the most important topic right now, with AI and with Oracle bonds and I mean capex in general, everything that's going on with Google and NVDA.
mhm. Yeah, so I posted about that. I basically liked Google because they have those TPUs, which might end up being like better than NVIDIA's technology even. It's totally possible. Um, so yeah, I've been long Google on that thesis. Also, their Gemini's like the number two player in AI probably, and that the rate of change, it's sort of implied it could be the best one in a year. And so if both of those theses work at the same time, then this thing's still going to go up another 50 or 100%, I'd say. If only one works, it's hard to lose that much money. Um, Unless, of course, if the whole AI bubble-ish kind of, you don't even know if it's a bubble. Let's say it is. If that bubble pops, of course, you're going to lose. NVIDIA, I've thought it seems precarious here for quite a long time. It was way too cheap in 2023. I quit this year finally because it became apparent to me that their moat might not be that strong, plus the TPU threat. So that one's not that interesting. I still think companies like Microsoft and Apple are very threatened by AI. I don't really see any good opportunities for them. It just seems pure negative. Oracle, it's just sort of like an old man who, you know, I mean, it makes
Wants to
sense
stay
because
young,
I
like
yeah,
Larry.
exactly. I think AI could be used as a way to do medical research. I think that's by far the most
Yeah,
real reason to even do AI. And he's a really smart guy. Maybe he sees the
yeah.
same thing. So if I was in his shoes and I wanted to live forever, then I would be going all in on AI because actually, who gives a damn if you go bankrupt in 10 years? It doesn't matter at all to you. You're gonna like
Yeah,
not
he's
have the
like
money
80
anyway,
years
right?
old.
Yeah, he needs to race to get this done. And so I think there's a good chance he's even quietly thinking about it that way. I don't think he's talked about it, but if I was him, I wouldn't talk about it. He's a smart businessman. You don't want to tell people what you're doing. I don't think any of them would say what they're doing. Um, that's the thing though. Like Apple is not even run by an innovative guy. He's just sort of this guy who's good at squeezing out dollars from somebody else's great
Yeah,
product. The
Yeah,
Apple's really a bad one. Microsoft's maybe a little bit better, but they seem very by the book and cookie cutter and very systematic. Are they really going to like go start doing really groundbreaking new things like medical research? I don't really see it. It's not the same Maverick kind of thing as Oracle. Oracle itself, it's just basically an all-in bet on how AI hardware is going to turn out. And if it turns out that was money poorly spent, the company could easily go bankrupt. Um, because I mean, their profits aren't really that good, right? It's just sort of okay.
yeah.
Plus, I'm saying that AI could be a threat to their kind of business too. I don't know that much about Oracle, but um, Zuckerberg, I'd say he's more of a maverick. Maybe he'll go down paths to make a good AI product. I don't even know if he's trying to compete in the LLM stuff. I think the LLM stuff itself is just sort of a not a distraction, but like, there's a lot of other ways to play AI, and Zuckerberg's probably
Yeah.
smart enough to realize that. But he's not gonna tell people what he's doing. He's a very shrewd business person. He's made it very abstract. We're just betting huge on AI. What do we have to lose? Blah blah blah. But he's not going to tell people like, yeah, we're going to start diving into medical research. You're not going to tell people that honestly.
I also have the problem in understanding Alphabet. I think that's the company I even lost some money on. If we take everything last I don't know how many years. For example, I was longing Meta when it was like 100, 110. I was buying Meta. I was buying Google on this correction right now. I was before that I was buying in the 90s. But Alphabet, I mean Apple, I don't get that company. I mean it's now it's at all-time high. I mean how?
You mean
It,
Google or Apple?
sometimes I'm sorry, sometimes it's like a risk-off company. It behaves like a risk-off company. I mean, it's wild.
Sorry, are you talking about Apple or Google?
Apple, right now it's
Apple. Okay, I thought you were. I thought so. Okay, yeah. So yeah, I think Apple is it's a weird company, right? Because it's part technology, but not super especially. I've learned a lot about their culture from people working there. They describe the company culture as like very what's the word, like practical. Like they just want to get it done. They don't care how elegant or wonderful it is. They just sort of like, what's a very efficient way we can do this pretty well. And that doesn't really like make me think that they're going to make some wonderful thing with AI. Again, all they're doing is sort of, it's like part luxury brand. You're paying way more for a phone than you should be. And it's part like kind of technology. I mean, their processors, I guess, a bit, but otherwise, it's just they're assembling other people's technology and then they have the OS as a moat. So, you know, yeah, I think Apple here is not good.
And I have a
But
few more questions. I'm not going to ask many more. First, what do you think I forgot to ask you regarding the situation in Japan. What do you think about the yen carry trade? I think that people are much more aware now than they were when was the last problem like a year ago of that unfolding. I mean, even you have a large exposure to Japanese yen.
yeah, I've been in the yen carry trade since 2023. I'm owning stocks that earn in yen though, so it's not exactly a one for one. But I was 100% hedged on the yen until August 2024 event. After that, I think I switched to 50 to 75%, somewhere in that range on average. And yeah, actually, when like I think like David Einhorn's a contra, so when he was talking about being long the yen, I was like, oh, awesome, I'll short more yen here. So,
Oh my God, man.
and that guy sucks. But yeah, and so basically, it's this trade, like I mentioned in a past conversation. This trade has been working for 15 years. Nobody ever talks about it. The Jason Shapiro, he recently did an episode on the yen carry trade. Um, and his read was the same as mine. Like he's been in the investing world this whole time. He knows a lot of people in investing. in all sorts of different types of investing and everything. He's never actually met a person who's in the yen carry trade. Think about that. And I'm the same way. I've never heard of another investor talking about, oh, we should be in the yen carry trade. So that makes me think it's extremely uncrowded. It's probably more likely to work. It's still probably pretty asymmetric and everything. That's especially true with Japan's political situation where she's just saying, well, we're going to run it hot and we're going to,
Yeah,
fiscally and monetary. And
yeah, you should deleverage. I mean, it's obvious. There's no place for surprises.
yeah, the only weird thing, I guess, is that the long rates are going up so much.
Yeah, that's a problem.
Uh, but that just sort of makes fundamental sense too, right? Because if the government's saying we're going to play it fast, then you don't actually want to be owed yen 20 years into the future.
Yeah,
And sure that, but they can't really control the long end too much. But the short end, it's they're keeping it artificially low. So, and there's no way they can really afford to pay way higher interest rates. Even in real life, if I can like buy one of these new apartments in one of these new buildings they're building, if they're going to give me a loan, I would just go buy one of those on the 5-year, 1% loan or whatever, 1.5% loan.
yeah,
I mean,
that's
why
really good.
not? And
And
but it's the same thing with stocks. It's even better because in the stocks you're borrowing for 0.5%.
yeah,
And this is even
that's
better. You've better even better real estate than what I'm talking about. It's just you have you just can't bet too big for margin reasons versus if I buy the physical thing, then they can't margin call me on that portion of the loan. So yeah, I think that the yen carry trade's still good, and I love that nobody is talking about it still. Nobody talks about this.
yeah, that's interesting. I read somewhere that it's like 4 to 500. I'm completely off. 4 to 500 billion is in that trade. I don't know
Yeah,
how
maybe.
they can calculate it, but I mean, uh, I don't know about that. And what would you say is there a thing that concerns you and makes you scared right now that could happen? Is there
With
something that you are worried about in the markets in the world?
like
I mean, you're prolific short seller. It would probably help your performance is if something bad could happen in a way. Let's say
yeah,
global slowdown or a global recession or
I
escalation
think that
in
I think
Taiwan.
that the likelihood of a recession today is really underappreciated, and it's because we haven't had one in 15 years. I've been wrong so far, but I think I posted about a year ago or 9 months ago or something that it seems more likely we can have a recession than any point that I can remember. Um, in fact, I think if you just took out this sort of AI enormous spend, we'd already clearly be in a recession. Although, I guess consumer companies just reported kind of strong earnings. I mean, one I was short, it spiked 30% in a day, but their comparable sales were still down 3 4% or whatever. So that's
Yesterday.
yeah, and it's like, well, why did this thing go up? That seems like my thesis was on track. I don't know why this spiked 30%. People on Twitter are saying how, oh, this is surprising to the upside. And a couple individual companies, sure, but when I'm looking at the things I'm short, I'm like, this doesn't look good. The consumer does not look healthy at all here. You have all these like delinquencies on credit cards and student loan and car loans. You have the value of the homes are dropping like crazy. Something like, isn't it something like forgot the number, but yeah, a lot of home values are dropping right now instead of increasing. Lumber prices are super down, so construction's down, new home prices are less than existing, and et cetera. There's a lot of like negative information out there. You just look at like the lowest IQ chart of it all, right? Is like the unemployment charts or things like this where they're going up, and it's like by some measures this is kind of cherry picking the measure a little bit, but every time the chart's been that bad, it's always been a recession every single time.
Yeah. Yeah,
Uh,
I know what the chart you're talking about. Yeah. When it goes
it's a
up
little
like
cherry picked. It's a
yeah.
little bit, but still, so that's not why I'm running negative beta. I just run negative beta now because that's I generate too much alpha on shorts. That's it. Um, but but yeah, I mean, I'm glad that I have the shield if we do get the recession, because if we get a recession and let's say the AI thing dies down at the same time, the market's going to drop like at least 40%.
Yeah, that's for sure. And I mean that's a scenario where it happens, but I think that Trump is very well aware of that, and we still live in a world where you have 4 years of political term. So your main goal is to win the next one. So first of all, I think that they are going to support the AI. They might say that they are not going to do it, but I think that they will because it's already now too important. Investments are too important right now. I mean, TSM is coming to US. I mean, it already is there. A lot of investments, a lot of government involvement, and I think that they're going to do more of that in the future. And if we look at China, they did a lot of good things with certain industries because of state capitalism, because state was okay. We are going to give you tax benefits, we are going to give you subventions and stuff like that. And I think there's more government involvement, and on the other hand, we do have this extremely large fiscal deficit, and it's not going anywhere. Simply, it's not going anywhere. And with that amount of government spending, we would have a recession like in 2000 and at the end of 2022, beginning of 2023, if there was not such a large government spending, in my opinion. But I mean, you take a lot of the point of restrictive monetary policy with the expansive fiscal policy, and that I mean, what you take off the power, a lot of it from monetary policy. But the way we are going to lower rates, I think that's why Trump is pushing so hard to for them to lower the rates because they know what's going under the hood. They know that there's like 10% of population generating like 50% of the consumption, which is like completely crazy. It's highest level in like I don't know how many decades. Definitely highest in the last five decades.
It's yeah, same reason Mamdani won. Same thing.
Exactly. And what do you think about that? Why I'm asking you this? Because I was looking recently at some popular trade was to long Miami real estate companies and to short New York real estate companies. Do you think that's overblown? Because his goal at the end of the day is to have more real estate, and I mean, it's contrarian thinking from my side to
Mhm.
maybe New York real estate companies are along now. I mean, maybe
For me, it's just easy to be short, like the San Francisco
yeah.
one. And the like I was short some New York bad offices too. I like shorting the offices out of all the real estate. Um, and so I'm shorting that basic idea because these people are going to vote to make the place even worse. But even without that political thesis, I think the fundamental thesis is great and straightforward too. Um, and then longing Miami real estate, I don't know. It seems like very mediocre to me when I look at valuations and things anyway, and I just I don't really see it.
I think it's all that trade is probably. I think it's already over. I mean, some of them went up like 50%, 100% in a short period of time. It was basically a short-term trade in a
Yeah,
sense. But I
yeah,
think New York real estate is. I don't know where this could go. It could go either way.
Hmm.
But I do agree with you that it's probably going to get worse
The
because
thing is, these things can be a bit of a death spiral because New York kept getting worse for a long time until
yeah,
the people finally got so fed up with it they elected a Republican.
Rudy
Does it
Giuliani.
feel like they're close to that today? I mean, I just don't. It's not even on their radar today. They're not even thinking about, yeah, it was Giuliani. So, are they going to keep voting for these kind of socialist people? Are the socialist people even going to follow through with their terrible ideas? It's hard to say. Mamdani seems pretty authentic, though. I think he'll do whatever he can. He's a believer. I don't think he's ever had a real job and things. I mean, this guy,
Nope,
of course,
never.
he's a believer. So to him, everything about capitalism is just rigged and flawed. So why wouldn't he just,
I mean, it's
you know,
crazy that today China is in some ways more capitalistic than European nations. I wouldn't say US, but the way it's going, it could be, but definitely than a lot of European nations. I was recently looking at the taxes in China. Taxes in China are way lower than in a lot of major European nations. Welfare state is not on that level. I mean, un, inequalities are also completely different. And I mean, it's in the same time really interesting world. On the other hand, it's you don't know where it could go. I mean, and I have to ask you a few more. Uh, Quick one. When do you exit short? For example, we spoke about Manpower Group. I mean, it's a terrible business, terrible company, stagnant company. For example, they went up 10%, I think, in 2 days. So when do you consider actually closing, if you have them, of course? Uh,
I don't think about it too much. And I especially don't think just because, I mean, the last couple days were kind of wild. We also have the whole Thanksgiving effect. During Thanksgiving week, I don't even really pay attention to it. Uh, so yeah, I wouldn't really quit unless like risk management kicked in, but that's 10, 20% moves not causing that. Um, I usually just like to let winning shorts run after they've been winning. I don't even, I usually just because the position gets a lot smaller and then because my account's winning too. So let's say short's down 50% and their account's up 40%. This short is just all of a sudden got really tiny. And for tax reasons, I just don't want to quit even. I just leave it alone there almost always. So to me, that's, I guess, the ideal situation. If anything, I'm more thinking, how can I add to this thing? Because that's the kind of situation where, let's say that the fundamentals have deteriorated a lot, even worse than I thought, and uh, and my account's been winning. So now, what was originally, say, call it a 40 basis point position, now is like 18 basis points. Um, that's not a spot to quit the short at all. That's a spot to re-up it and maybe even go up to zero point 0.5,
hmm,
which is not intuitive. And I think that's why the fact that short sellers, it's kind of emotionally hard to do it, right? Because especially the times
yeah,
where you lose it all back and then some, that's really
yeah,
lousy, but that shouldn't matter at all, right? The market doesn't care what price you paid. Um, yeah, in that situation, you should be adding. And the fact that it's so emotionally hard to add, that tells you why it's probably good to short it because other people don't want to do it. And it's very annoying because, like, a third of the time, you are going to be wrong and it is going to cost you money. But, or even if it's 43% of the time or whatever, that's still a good bet. Bet on the 57%, man. Don't get caught up on did the short that was winning turn into a loser? That's like totally the wrong way of thinking about it.
yeah,
Um,
yeah. Thank you. Because I'm always looking to like win, to not
yeah,
win.
Yeah, just play the odds.
Yeah, basically just play the odds. I mean that's the poker player speaking from you.
Yeah. Yeah,
And
you gotta do it that way. You really do, because yeah. I think that's a big leak people have is just quitting winning positions generally, but it's especially true on shorts. A good reason to quit a short is, let's say that like really bad seeming news came out, and at first you sort of think, oh, okay, that's pretty bad, but you're not that sure about it, right? And then let's say you've been stewing on it for a week or two and you're like, was that really that bad of news? Or, is the market like way overreacting here? Like, let's say, like a good example would be like a legal threat or regulatory threat or like a CEO scandal, especially with something not even related to the business, like the CEO got into a fist fight at a bar or something. It's like, okay, that's not great, but does this actually matter that much, sort of thing, for the company, what actually changed is a good way of thinking about it. Like, okay, the CEO has some issues, but he's been CEO for 6 years, and here's the results of the company since he's been CEO. Nothing's actually changed here, right? Or like, oh, the government is alleging this horrible thing about this company. They're saying the company is going to owe like 1 year of operating income, right? But now the stock is down 50%. Think about that. It's like, okay, let's say that they did lose a year of operating income. What is that really even going to cost? This is like maybe the stock should be down 10 or 15%, but these things will be down like 30 or 50%. And in that instance, that's a good reason to quit a short. It has nothing to do even with like whether you won or lost. It just has to do with like um, the facts didn't match the extreme move, sort of thing. That's a good reason to quit. Another good reason to quit is just the fundamentals are turning. Like this company that had been losing money, or like your whole thesis is, well, revenue should be going down, and it just stops going down for a few quarters when you weren't expecting it. But especially if the stock is now dropped with the factor that had been weak, but this one is sort of earnings wise being an outlier. In that case, sometimes you spend some time and you try to figure out, well, why. Sometimes, for example, they're like pushing a one-time price increase, and that's actually really bad for the product long term or whatever. Or sometimes they're pushing a one-time quality decrease. That's the worst thing a company can do, right? It's now they've just basically given their call customer base the middle finger, and sure they shafted them once by saving cost. Um, but if you figure out that's the reason why, let's say that the stock even went up a little bit on that supposed good earnings, then that's a spot to even add to the short, not take it away. So you just really have to focus on what the facts are, and really not try to tie it into what price you initially entered into or whatever. That because that doesn't matter at all.
yeah, and it's mentally really challenging to be a short seller. I
Yes.
mean, it's really complicated. You need to be patient when the market is going up like crazy. I mean, let's look just, I mean, for the last quarter, where, I mean, last quarter, as we said earlier, was just complicated for short sellers. And I would like to ask you, what's the belief you completely changed in the last 5 years? And I mean, you said that you thought that you were lucky, and then you realized that you actually had an edge. And through that process was something that you are like thinking about the market that you realize it's not as you thought before,
Um, in 5 years. I mean,
or three, or something that you.
yeah, I'm trying to think. I'm starting to think that what I do will scale better than I expected, maybe,
Hmm.
but I'm still trying to stay very humble on that, especially because I can give you specific examples all the time where I think it's costing me money, but what I'm underestimating is that the ideas I can substitute with are good enough. It basically doesn't move the needle, especially because now I always think in terms of like a Sharpe ratio. um, that kind of thing. So, um, yeah, maybe just because I can't get that as big of a score on the bankruptcy short as before. Because, you could make a percent or two in a flash there before, and you can't do that anymore. But maybe in terms of risk versus reward, it wasn't even that good to be doing that in the first place. And maybe these, winning at 0.4% instead uh is just completely great, just in a different way, because it almost becomes, it's not a free lunch, but there's not real risk there at that size anymore. Not really. You could lose a few percent maybe in a really horrific outcome, but that's not that bad versus before. It's like you could lose 15% if something truly horrible happened there. And you stayed wrong. Versus now today, of course, you can't bet that big even because you'd be forced to stay wrong, right? Because now the liquidity is too small. Now you just sort of watch it go against you and you just hope it would stop going up. That's why you can't uh, bet bigger. But in the past, it would be the case in the middle of the move, I'd be risk managing and you'd be sitting there eating this huge loss that was risk managed, but those losses really screw you up, and it's usually at the exact wrong time and things, and you have to rebalance the portfolio a bit there, and I don't have to do that at all anymore. So maybe this will scale somewhat better than I thought. I don't think I still don't believe in this idea you can run like 500 million though, and just it won't affect your performance that much. I think I'm still pretty sure, but now at first I thought, maybe at 30 or 50 million, that would start eating into my edge a lot. And maybe in terms of the raw IRR, it is somewhat, but in terms of the risk versus reward, maybe it's not nearly what I expected. Um, but yeah, I'm not gonna. I sort of like the idea, even if I'm wrong about the scale thing, where like let's say it does scale somehow pretty damn well at 500 million still. I'll still be glad I did it this way because ultimately it'll compound that many more years, right? Because for sure at some point everyone will agree that scale gets you at a billion or two or whatever the number is, and it will always catch up to you. So if I can delay that for another few years, 5 years or whatever, that's great too.
And what would you say are the biggest lies of Wall Street? And I mean, well, some kind of a lie is that those guys that did well before are still relevant. Maybe it's not a lie per se, but some kind of like a marketing trick. As you said, David Einhorn, I saw his its ETF or whatever it is. I mean, its performance is horrendous.
It's a good
Uh,
short.
for example, yeah, and I mean a lot of those guys, Michael Burry, and that's only like value. I mean, he closed his fund like a week ago. I mean, a lot of them are like not really good not really relevant, let's say, right now, but they do have an impact on the markets. And you were really critical of that stuff. And what would you say are like the biggest lies right now that they push on retail, on regular investors?
Yeah, in that case, I don't know if it's a lie. Yeah, it's they're because the same thing happened in poker. You sort of have these poker celebrities, um, and they were pretty much all bad. Like Phil Ivey was actually pretty good. He was actually a
Yeah,
good player, but basically the rest of them were bad. Like all of them were bad.
Daniel
Like guys
Negreanu
like
as well.
he's actually pretty good too. But sorry, so him that good exception there. But like Phil Hellmuth, guys like that,
Yeah, he's terrible.
Howard Lederer, these guys are awful at poker, man.
Yeah,
Um, and the thing is, even Phil Ivey and Daniel Negreanu, they're not as good as the top internet guys. They're not like sitting there playing anyone in the world, just crushing everybody or anything. They're still picking their spots, and which is smart. I'm not berating them for playing poker that way, but the actual best guys in poker, they didn't get much attention at all. And the life cycle of poker pros is too short, so they, in most instances, never got the recognition. In investing, eventually, you do, for sure. If you just keep putting up huge numbers year after year, it doesn't matter how disliked you are or anything, but it's going to take a long time for someone like me because I'm like an extreme outsider and I don't do things that make people want to, do me favors and things because I'm basically very critical and honest with what this actually is. But yeah, as far as the actual like lies of investing, it's these professional marketing people. It's almost all of them. It's like almost all the people in this industry are pretending like they have some valuable insight, they do good research, they have an edge in their market, whatever, right? And then they try to wrap it in something where they're getting paid for it. Some like, oh, we've got this quantity sort of thing. We'll send you signals, or we'll write these articles, or you have my Substack, or buy my crappy ETF. I pointed out that I don't even know how to say his name, Warren Pies or whatever. That guy, his ETF is horrible, and like I knew that was
Yeah.
bad because
I
um,
couldn't believe it. Even Citrini index, it's horrible. I mean,
yeah,
uh,
that guy's he's just a marketing guy.
just a marketing guy. Yeah, he had one good call on Silicon Valley Bank, and I mean that made him famous. If I'm not, and it was really not a really
Yeah,
complicated call if you are into the industry.
it wasn't
It was,
even his call too. Like other people were writing about it, and he
well,
probably I don't want to say he plagiarized it because I don't know the timing and everything, but I think he probably just copied someone else's good idea there. Um, you know, so I find the whole thing really distasteful, or I sort of ripped on that guy yesterday, I think, and I said like this guy's saying how track records don't mean anything.
yeah, that old guy. Yeah, two gray beards. How
And
can you
man,
say something
it's
like that,
yeah,
man?
but it's weird because he wrote that, and if the conclusion was track records don't mean anything, thus you should just buy a broad basket of stocks and just sort of play the market as a passive investment.
Yeah,
I'd respect that view. I'd be like, oh, okay, maybe he doesn't know how to evaluate or whatever, and fair enough. Most people claiming to be good aren't good and everything. But if your conclusion is, and thus you should buy my product, it's like,
yeah.
dude,
No.
what are you talking about here? And it's
And
just
listen
so,
to my podcast, and you know,
it's just like, dude, you are so dishonest.
yeah,
And I posted somewhere too. I said like these kinds of people aren't even exactly. In some cases, it's just mercenary, like they want to scam people out of their money, very like it's malicious. But I think that's probably not even the case most of the time. A lot of the time, it's just people protecting their ego. So
yeah,
in that case, recently, I think that guy twisted things up in his mind enough, and he only did it to say to himself, just because your track record's bad doesn't mean that you're bad. And then I think the people reading him who they don't want to blame their bad results either.
yeah,
So it's sort of
yeah,
like if you invert what he's saying, it's like he's just telling them what they want to hear.
yeah.
You're not bad at investing just because your track record sucks. Like, okay.
The funniest thing ever is when a guy is like, okay, now I invest in business. I am a long-term investor, and not because he's buying some like garbage companies, but because he's relying heavily on a value factor, for example, and he's underperforming 5 times. I mean, and he's like, I invest in businesses. I'm not a gambler.
Yeah. It's like,
So
okay, man.
a lot of that, and I mean, I even went through some like ETFs of quant let's say pod shops and popular pod shops and investors, and I mean pretty much most of them are really bad, like really 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 bad.
Yep.
The special quant strategies, and I mean you, and as you said, quant ratings, I mean it's all, I mean valuation is so relative that it's like really complicated. It valuation basically comes down to each company differently. I mean, and then you are like going to find something. What you're going to do, you're going to bet on momentum factor, like
Yeah.
pretty much all the technical analysts and or a lot of funds and the CTAs and stuff like that. I mean,
hmm Yeah, one interesting thing, I'm not even going to name the guy doing it, but it's interesting. His fund, he kind of markets it as like a long short fund that's doing quantitative fundamental screening or whatever to pick its longs and shorts, and it's long and short hundreds of things. It actually performs really well. So early on it didn't do as well, but for the last, forget, 5 or something years, it's done really well. But it's interesting because he doesn't actually say, like, basically they changed one major thing there. So all they do now, really, all this really is, it's wrapped up in this kind of fundamental thing. And he's actually said that they do this now, but he says it as a secondary. But really, this is primarily what the fund does now. All it does is trend following on factors, factor pairs. And it works. It's actually a pretty good strategy. But I guess if you just said the strategy that simply, like, oh, we're like long, whatever, these types of companies and short those types of companies because those ones are going up and those ones are going down. And we're doing this for like a bunch of different factors at the same time. It's like the obvious example would be say, okay, well, we're just long S&P 500 versus short the Russell 2000 sort of
yeah,
thing. That's just a trade that works. And so
yeah.
if you mix in like 20 things like that and you wrap it up in this other story, then that's actually a pretty good product. The thing is about that kind of a strategy, though, is it's not terribly complex, and eventually it's going to become crowded, and there's not really some rocket science going on there. So
And one more question. I mean, you said that first one, a quick one, quick. You use AI in research. You said that you use ChatGPT's deep research. Do you use anything else right now?
I still just use ChatGPT. I have a network of people who I trust a lot, and they're comparing some other AIs. Gemini recently has gotten kind of close,
Yeah.
but it seems like it's still slightly worse. Um, I might get Gemini anyway for if it's a close spot to get a second opinion. Sort of see it that way maybe is useful, but for now I just think use the best one. And you know, I basically have people trying to stay on top of if anyone else is going to be as good. So I think there's a good chance Gemini will be best in 6 or 12 months.
I mean, I do agree with you. And last question. You said that you work a lot. I mean, you work basically all the time. Uh, when do you sleep? Do you go to sleep every time the same?
Yeah, I get pretty regular sleep schedule. Nowadays, I don't really even stay up for the US stock market hours much, unless something's going on or if like my body's telling me, hey, you should probably stay up. But otherwise, I'm just not. Um, I try to, some mornings I'll wake up before the market closes now because the market closes at 6 a.m. here. So that's kind of nice because you can trade the really liquid last 30 minutes there. But yeah, I have a pretty consistent sleep schedule. I'm getting, about 8 hours of sleep every night. That's pretty important. I think that's just good for performance.
And do you train your body? Do you do some kind of training? Do you use some kind of supplements?
I started lifting weights again, and I've been on testosterone replacement therapy for a long time. I don't use any other supplements or anything. I don't think they really, I've studied that years ago, and I don't think they help at all.
Really? I recently started using like vitamin D, B, omega 3.
Yeah, I went down the same rabbit hole, and I was on those for years too. I think vitamin D is maybe the best of the bunch because there's no possible downside. And it's so cheap. And then omega 3s, I think it's just way healthier to get it from like real food.
Yeah, but
So
you need to eat a lot.
in Japan it's so easy, but
Yeah, in
even
Japan it's easy, man.
but the thing is if you just buy salmon and eat salmon 2 or 3 times a week just as like a salmon steak, and I don't know where you live, but in America it's so easy to get them now.
It
You can
is
get them
it's
like,
easy here as well, yeah.
yeah, so just do that, and if you cook that like 3 days a week, that's a ton of omega-3s. And I'm pretty sure that eating it in terms of a real food is way healthier than the supplements. B, I don't think matters really unless you're like not eating enough meat generally. Um, and then maybe you went down the magnesium or zinc
Yeah, I
rabbit
do.
holes. Yeah, so I don't think it matters. This is just if there is a gain, it's super marginal, but I think it's just good to eat like whole foods that are healthy. You want to eat like lots of lettuces, lots of things like that. I healthy. So potatoes are good, you know.
I'm asking you this because I recently had a conversation with ChatGPT, and I was like, okay, I want to get in 10 years to be top 1% hedge fund managers in the world. Be completely honest and tell me what I need to do. And I told him everything, my whole life, my whole, trades, everything. And he was like, first of all, you need to sleep. That was like the first thing. I mean, because I don't get regular sleep. Sometimes I go to sleep at 4 or 5 a.m. Sometimes sometimes I don't sleep at all. So, I mean, it's ongoing for a long time. I know it's a terrible thing, and that's why I wanted to ask you that.
You need to
That
be on a fixed schedule. It doesn't have to be
yeah,
the same all the time. This matters a lot. So these supplements are kind of BS, but it's very clear in the research. What you want to do is like go to sleep and wake up at basically the same time every day. And you can decide, it doesn't have to mean you wake up every t day at sunrise or whatever. It doesn't have to be that, but you got to be consistent because your body needs to be on a clock. That's really clear in the research that I read.
David, man, thank you very much. I really enjoyed this conversation. It's like more than 2 hours. I could talk to you more 2 hours more easily. I mean, we went from markets to geopolitics to in some kind of philosophy to, and now we are ending it with health and nutrition. So,
Supplements.
and supplements, yeah, supplements.
Yeah.
Thank you very much.
Yeah,
I hope
thanks for having me, man.
and I hope to have you again. I mean, you are the guy that's like here, first guy to be here for the third time. So, and I hope there's going to be fourth and fifth, and we are even considering
Yeah.
opening a channel that's going to be only for on English. And I do think that there's a problem when it comes to FinTwit and when I mean financial community in general, that people are not completely honest, and they are not inviting people that are. For example, my idea is invite guys that actually practice what they preach. For example, the things we spoke about like 10, 20 minutes ago. Again, thank you very much, man. And I hope to have you again.
Yeah, happy to be on again. So,
And thank you guys for following and listening to us. See you on the stock market.